What's up everyone, it's Karthik with Moneyvest. So I've spent a lot of time researching and analyzing over the last day, and there seems to be a lot of bearish sentiment going into next week. So I don't know if you feel that, I don't know if you can read the room, but there seems to be the markets are giving us a bit of a bull trap and the markets are giving us a fake bounce, and we are headed even lower in the upcoming weeks as inflation data comes out, as FOMC members start talking. So this right here was a post from Heisenberg on X, and I want you to comment down below, and so that we can get a nice idea and even a better poll from our own members. And what are you expecting for the upcoming week? Is it scenario A or scenario B? So this right here are two scenarios that they lay out, where the S&P 500 breaks down below the 50 simple moving average, recovered some, and then will this fade back down like scenario B, or will this just continue on up like scenario A, where the markets start to recover back to pretty much near all-time highs? Or are we going to see a bigger sell-off, potentially down to that 100 simple moving average, and make some new lower lows? Last few times we have seen this right here, scenario A, where the markets did break down below the 50 SMA, had a nice little 4 or 5% pullback, and then recovered fairly back quickly, and then pretty much back to all-time highs. But this right here is, of course, the 2022 bear market, where scenario B, where the S&P 500 broke down below the 50 SMA, and then recovered slightly, but never reaching over the all-time highs, and of course sold off even further, breaking down below the 200 simple moving average before falling and creating a peak for the markets down over, I believe, 25 to 27%. So let me know in the comment section down below, and where do you stand between these two scenarios? Now, a few things that I really want to address here, that we're going to really look at the relative strength index. Where did we end up on the RSI and on volatility? Because I think if you are going to compare the current market scenario with previous technical scenarios, we've got all the data. Like, we've got all the numbers that we can look at to better understand where we currently are with this market with regards to its technical measures. So what I'm going to do is I'm actually going to remove some of these other things, and let's just quickly analyze where we are at the moment in this market sell-off versus where we were in the past. So you'll notice that at the very bottom of this market sell-off, from its all-time highs all the way down to as low as 5,000, close to 5,000, we saw the S&P 500 down over almost 10%. And the RSI, if you take a look, was trading all the way down to low 30s. So that right there was the RSI reading for the market when it actually was down, from its all-time highs down almost 10%. In the past, you'll notice that this right here is another sell-off where we witnessed S&P 500 down a little bit over 6% from its all-time highs, and again made a nice little bottom before rallying back to all-time highs. RSI also, once again, in the low 30s. Let's move back a little bit further on this chart. And this right here is the 2023 sell-off from August all the way till October 2023, down over 11%, so in a bit of a correction. And the first time you'll notice that we actually did see the RSI down in the low 30s again, where the markets were right over here. We did recover, but not quite back to all-time highs, but then sold off even further to make a new lower low. And this right here was an even more of a lower low and sold off even further. And all three instances, we got a bit of a jump on the RSI and then sold off even further. As you can see on the chart, that yes, we did see a little bit of a pushback higher, but that wasn't enough. That momentum and that breadth wasn't enough to take us back up to all-time highs, and we sold off even further. If you go back a little bit here, and let's just go back to the 2022 bear market. So that's going to be this right here, from January of 22 all the way till October. So that entire year, the markets were down over 26%, and multiple times, multiple instances, we actually witnessed the S&P 500 again down here. RSI extremely low. Over here, again, the S&P 500 is lower. RSI not quite super low, but again in the 40s. And this right here, of course, was a new low, a pretty significant bear market trigger on the S&P 500. And this right here is where the RSI was. Again, this right here is where the RSI was when we were coming down even further. So every time we have seen these market bottoms, you better believe that the RSI has been pretty low in the low 30s before rallying back higher. But that has not been a pure signal for a market bottom, because the markets can recover a little bit, as they have done multiple times. You can see the RSI pretty much went from, on June 14th, 2022, went from like 24, 25, all the way to highs of 56 to as much as 70, where the markets had this nice little rally over here, only for it to fade back down, and of course for the RSI to also come back lower. So what we can do is we can also try to understand how volatility played a role between all these market sell-offs. So what I want to start with first is actually go back to the COVID crash. So this right here was the pandemic, as I'm sure you guys know and remember. And this right here is volatility during the pandemic. And what you'll notice is that we actually saw an increase of over 500% in the VIX, right? So 525% as the market's S&P 500 dropped over 36%. But the interesting thing is that actually did not happen in a span of 1 day or 2 days. It happened in a span of total close to 27 days. It took us 27 days to go from 14 VIX value to over 87, right? So that was a 500% increase over 27 days. And it also took the markets about 31 days to actually fall to all-time, to fall to pretty much down 37% from its all-time highs. Now, if you come over to February 20th, 2020, this is where the VIX was at around 14. And if you come over to the S&P 500, this right here is February 20th. So this is where we were. Volatility being extremely low, markets being at an all-time high. And then guess what happened? Of course, these two charts flip, as you can clearly see. As volatility spikes here, we see the markets, of course, selling off quite aggressively. And that happens over a span of close to a month, where every single day VIX is going higher, 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 and then it peaks out at over 88. And of course, the market's bottom here, close to 2100. And then slowly and steadily, as the VIX starts to fade and comes down, we see the markets recover back higher, albeit a little bit slowly, but that was the overall trend for the market. As the VIX goes up, volatility continues to spike, markets come down, and the VIX tops out, the market bottoms out, and then the reversal starts to begin for the market. Now, we can also draw some other conclusions from the previous analysis here. So if you come over to, let's say, the sell-off from 2022, again, if you come over to this bear market, and then let's just go over to 2022 here, you'll notice that this right here was the VIX spike during the entire year. And it was actually quite muted. We didn't quite see volatility spike as much as, of course, during the COVID time, because this was a more prolonged market sell-off. It took us many months to get down to the lows of around 3,700 to finally create a bottom and then, of course, start reversing back up. So this right here was December 2021. December 2021 volatility was right around here. So in the low 16s and 17s again. We got our first spike in January of 2022, and that was increasing all the way to 36. And this right here was the first sell-off. So December 2021 all the way through January of 2022. So this right here was the first sell-off on that corresponding VIX spike that I just showed you. Then volatility came back down and then came down to 20 and then spiked again. So this right here was, and again, I don't really call these spikes. These are more like, volatility increasing on a more sustainable, more consistent basis, getting up to over 36. And the markets, of course, topped out around 4,400 and then sold off even further. Then VIX comes down again. So this right here is a volatility crush coming back down to 20s, and then again increasing a little bit further to highs of over 38, almost 39 and 40. And this right here was that bottom back in March of 2022. So this is March of 2022, and then kind of peaking out in May of 2022. So this right here was once again May of 2022, and then further lows in June of 2022. And this right here was June of 2022. So volatility in general was a little bit more muted. We didn't really see a lot of big spikes or big crushes. It was just kind of flirting between 20 and 40. It was going from 20 to 40, back down to 20, then back up to 40, then back down to 20, back up to 40. And that was 2022's bear market, which was also very, very difficult to trade because volatility didn't really spike a lot, and it also wasn't getting crushed a lot. So this right here was the final time we actually got up to as much as 33, 35 in October, and that's when the markets finally bottomed over here. And this right here, the consistent red candles you see in the volatility, of course, coming back down in August of 22, and that right there was the peak of August of 2022. So the idea here was that, some volatility spikes we have seen in the past that have been shorter lived and more violent, versus some volatility spikes we have seen is when the markets are on this consistent lower highs and lower lows, and the volatility also is not spiking, but it's also trading in a range, and it's more muted than historical spikes. Now, if you come over to what we witnessed for the markets last week, which was actually quite crazy and unusual, it was nothing like what we had witnessed in 2022 or even during the pandemic of 2020. It was more like a one-day event. It was quite literally not even 1 day. It was quite even 1 hour event where the volatility spiked from lows of 14, 15 to highs of over 65. That was over a 380% and 30% spike here in volatility in a span of just one day. I mean, pretty much 2 days. I mean, we did see the volatility also already creeping up on Friday. Friday, the volatility was up like 25, 26%, getting up to over almost 30. And then, of course, on Monday, we saw a huge spike to over 65, up over 180%. So it really was a 3-day event, Thursday, Friday, and Monday, where the market spiked the way they did. And then now we're seeing a huge crush back lower, down 68%. But we are still not out of the woods in a sense that we are still at 20. I mean, volatility could still trade between 20 and 40, as we discussed in the 2022 bear market, where it was consistently trading in between a range of 20 to 40 as the markets were making lower highs and lower lows. And I think that's really important for us to understand. This is not a bearish or a bullish call, but really just an understanding that if volatility continues to trade in between 20 and 30, right, 20 or 40 to be more precise, the markets are going to be in this sort of downtrending channel where they continue to make some type of lower highs and lower lows. And this could be a beginning of a much bigger bear market. In order for us to really understand whether there is this is a dip or this is a pullback, I think moving averages are one of the best ways to do that, because if I bring over some of the other previous historical times, you'll notice that this right here is the 200 SMA, I believe. So this is actually, so this is the 200 simple moving average. And in the past, you'll notice that every time you've been trading above this level, it's been pretty consistently above that level. And every single time that dip has been bought up. But the moment we start to kind of break down below this, then that starts acting as a bit of a resistance for S&P 500. So this was again back in 2022. As you can see, that huge resistance on the 200 simple moving average, perfect resistance here for the 200 simple moving average. And then once we start to break above that level, it starts acting as a very good area of support for the market. So as it stands right now, we are still within the context of a uptrend as per the 200 simple moving average. As you can see that we are trading above that level, and we are consistently sort of making higher highs and higher lows, coming back down, pushing higher, coming back down, pushing higher, coming back down. So we are still within the context of this uptrend. So this volatility spike could very well be a 3-day event. But if VIX continues to trade in this range-bound pattern where it's between 20 and 40, and we do get a spike once again, then of course there's going to be a potential for those lower highs and those lower lows once again. So this is purely technical, and I think it's really important for us to keep in mind that if the volatility continues to trade between 20 and 40, that's going to be more of a market where we have to really be patient, because the October 2022 sell-off, the bear market of 2022, was very much longer lasting. It lasted for over 10 months, right, before we finally found a bottom and then started that reversal back up. It put many people in a state of so much confusion and uncertainty that people were expecting all-time highs 2025 or even beyond, right? We didn't quite expect all-time highs anytime soon. We've done many polls back in 2022 when the markets do expect are going to hit all-time highs. People were expecting 2025 or even later, and that's what the markets can do to you, right? If they continue to sell off, if they are in a bear market or in a full-blown correction, expectations for gains and expectations for returns diminishes over time significantly. So the bottom line is keep a close eye on VIX. VIX is the answer to most market volatility, of course, and where the technicals end up. And also keep a close eye on the Moneyvest index, because this also accounts for a lot of market breadth indicators, as well as the overall percentage drawdowns, as well as the RSI, and as well as 4 or 5 other calculations that we have plugged in for all technicals. So if you are not just looking at volatility, definitely look at the Moneyvest index, because it gives you a very clear idea of where the risk reward is. And you can, again, go back to look at corresponding figures, and you'll very quickly understand that the volatility is just one of the many indicators that we look at. But the Moneyvest index has been very good in terms of making those decisions, and just pick random dates, right? So go back to August 25th, 2025, and then take a look at where the markets were back then. So August 25th, 2015. So if you come all the way back here, so this right here is where we are. June, July, and August of, there we go. So August 25th, 2015. So we were at S&P 500 1800. So we were from its all-time highs down a little bit over 11, almost 12% in a bit of a correction. And the Moneyvest index was, of course, down here at 1.9. Another dip here at 2.2 in September of 2015. So again, if you come back, this right here was September of 2015. So boom, right there, double bottom for the S&P, and then another few times in January, February 2016. And you come back here, this right here is January and February of 2016. Once again, putting us in a nice favorable risk reward ratio position. So this is one of the indicators to really help you make decisions when it comes to buying. This is not a selling indicator. This is only a buying indicator to help us better understand where the risk reward is the most favorable and where the opportunities are the best, so I can deploy cash as much as possible and take advantage of those market sell-offs. So that's where we are. Going into next week, just a bit of a recap. What I'm really looking for from the markets is a couple things. Number one, volatility. Is it going to continue to get crushed back lower and trade below 20? Or if we're going to be in that range between 20 and 40, something that we have witnessed, since in 2022. The second thing is, are we going to continue to trade above that 200 simple moving average that sits at 5,000? I think 5,000 is going to be a very critical level for the S&P 500. So that's going to be this level right here. And it also kind of coincides with a support, a horizontal support, I should say. So this right here. Previous support level for the S&P 500, also aligned with that 200 simple moving average. So that is going to be the most important level that I'm paying attention to. If we actually trade down to that 200 SMA, break down further, then I would be a little bit more cautious, and I would assume that the bear market or the correction is going to be a little bit longer lasting. It's going to take us a bit more time to see things out with interest rates, inflation, the carry trade, everything, to have a better idea of how long this could be and how severe this could get. And third and last, most important thing I'll be looking at, of course, is the Moneyvest index to better understand, where the risk reward is and how favorable it's now starting to get. Even if the markets break down below the 200 SMA, I'll be keeping a close eye on the Moneyvest index to see where it is, whether it's at 2.4, to then deploy capital and, of course, be more aggressive into the market. So there you have it. Going into next week, that's how we're positioned. Many people are expecting for the markets to create a new lower low. I wouldn't be surprised if it does, if volatility continues to be a little bit more elevated, compared to the past. But keep a close eye, as when most people are expecting something, the markets end up doing the exact opposite. So that's also something to keep in mind. So don't wait. If you are finding opportunities, I think dollar cost averaging into those opportunities is very useful. So let me know your thoughts down in the comment section below. And as always, happy investing. I'll see you all in the next video. Check out the Discord and the Patreon link down below. There is a 16% annual discount available until the end of this month. As always, happy investing. I'll see you all in the next video.